Good morning, ladies and gentlemen. Happy Tuesday to you all. So today we're going to be going over the automotive sector. This is actually a requested video slash topic that someone threw in the comment section below. So we're going to be covering the automotive sector. We're going to try getting as many companies as we can in this video, but just don't want to make it too long. So timestamp down below for all the companies if you want to skip to a certain individual ticker. So the fundamental part of this video will be coming soon as well. So stay tuned for that. And with that, let's get into today's video. So first off, we're going to be covering GM. At post market today, they're trading about $33.67. If we jump out to the weekly, we can actually see a bearish slash bullish pattern forming. So this is commonly referred to as a bear flag. So GM fell from the $67 point down to the $30 point. That's your flagpole right there. And then basically we draw out the bottom consolidation. We're going to be a little conservative with it and go there. Then you copy the top consolidation to that to form your bear flag. Now, we are possibly breaking this flag downwards. If we actually pivot this slightly here, we can maybe see that we're right on that edge of breaking this flag downwards. So we have to be cautious from our downside on GM. This could also be forming a pennant, but more of a bear flag. However, due to it having three touches, 1, 2, 3, I would be expecting it to break down now. If we do get a possible retest of these SMAs at the $36.98 level, I could see it slam right back down to this level. Could be breaking this lower trend line support and then heading lower. So if GM were to break lower, and this is a big if, guys, got to wait for the pattern to complete and see how it goes, we could see very, very low prices. Basically, we take this upper trend here, put it to where the flag would break. We're coming down to $5, $7. That would actually take out the COVID lows here and possibly set up a nasty A to B leg. So if we look at the A to B leg, A to B, B to C, projects down to $6.44. So already this is starting to put up a lot of bearish intonations here, and you have the bear flag, you have the harmonics, all telling you coming down to the $7, $5 region. And usually when you have stuff like that, you have to look more bearish skewed. On top of you're below all the moving average. So you don't have any support to once you break this pivot point here of $30.12. You actually have gaps on the chart here, and you could probably stair step down through these levels of $24.25, then $20.20, taking out COVID lows at $17.74. Once you take out the COVID lows, you really don't have a lot of movement on this chart. You could be making all-time lows, and possibly if you get down that far, it could be someone like a Credit Suisse moment where GM long-term may goes bankrupt. I'm not saying that's going to happen. That's a big company. There's a lot of financials around it, but you're trading below this 200 weekly moving average. You're trading below all the weekly moving averages and daily moving averages. So it's just bearish overall. So the simple way to play this to the bullish side is to wait for the 200-day and 200 weekly retests. Once you get above the 200 daily, then you can possibly look into dollar cost average position. If you break below the 200 afterwards, you basically close out your position for a small loss. But personally, I would play it above the 200 weekly because it's just a simpler trade. We've shown countless examples on this channel that once you get above the 200 weekly and actually reconfirm, so you break above it, retest, come back, or you start expanding upwards, it just is an easier trade. It's just an easier multi-year expansion. You're above all the moving averages. Things just get kosher after that. That's where I'd be price targeting GM. Now, if we start to break the upper consolidation here, invalidate this pattern, then I'd probably be looking at a stair step up to these levels that basically where you find sellers previously. Obviously, if you look at the daily, there's different levels. First resistance then probably be the $45.97, next $46.77, $49.98, $54.04. So you have these levels that you're up here. On top of, if we look at the volume, you haven't really seen a very large spike in volume in GM. So this is not a bottoming pattern yet. So you haven't made the bottom yet. If you start breaking these levels here, then you're definitely gonna be bearish. So as of right now, I would basically say sit on your hands with GM. You're below the moving averages, it's just a bad thing. And also, if you're now, let's say you bought up in this $50, $56 region. So hypothetically, you would be at a 38% loss. Well, my response to anyone saying that it'll come back and all that, just look at Credit Suisse stock going to zero. We did cover that. Link down in the description below or at the end of the video to the Credit Suisse videos that we did. It can always get worse, guys. So let's say we come back to the COVID lows. You're taking another 67% haircut from that point, or about 30% more on from the position you are now. So the question is, it always can get worse. Yes, it always can get worse. So maybe think about cutting if you start breaking this area, the chart basically going lower, or if you just really want a stopgap, once you break $30, just get out of GM. That's just my opinion. And quickly, let's just jump over to Lux Algo just to see what it's telling us. So if we look at the daily, you do see the MACD trying to curl towards one another. So it is some bullish sign there. However, they haven't crossed. RSI is significantly oversold and oscillation hasn't totally bottomed. So you are heading for a reversal zone right at that $32.57 area, which would be a double bottoming at this point. However, if you break through that, I think you're coming down all the way to $31, having a dead cat bounce like we mentioned, probably retesting this trend line. Dead cat bounce off 30, retest trend line, reject, come back down. So that could be an interesting short opportunity. And if we just simply look at the weekly, we have a MACD crossing on the weekly here. So RSI has a lot more room to run to the oversold territory. You are possibly getting a buy signal, so maybe a bounce reversal here. But if we look on the long term where we could find support down this $24 region like we mentioned before, and this $21 region, the maximum reversal zone sitting in this $10 region. So definitely an area I'd be targeting, even maybe dollar cost averaging down from 20, possibly a possible investment. However, I would look for a volume capitulation rally at this point to get into GM because there is more downside risk than upside risk. Next, we're going to cover Ford. So just looking at Ford, you can clearly see a gigantic head and shoulders pattern, left shoulder, head, right shoulder, base at the $9 level. So if we look at Ford and draw this pattern out, basically your base is sitting around the $10 region. You draw it from the tip of the head down to the bottom. Once you break this head down, you're basically completing at a negative number. So there is a probability that this pattern completes and Ford goes to 0. However, it could also be part of a larger A to B pattern, which is on the bullish side. If we take from the COVID lows all the way to the top, then come back down to this bottoming right here, that would project Ford up to the $30 region. So that would basically be an all-time high for Ford. And if I look back in history, Ford really kind of squeezes right to this 200-day weekly moving average. It kind of trends with one or the other. So it really trends very closely to it. So, you know, the dot-com bubble came down, but it always kind of stuck to that trend line and then kind of breaks above it, breaks below it, breaks above it, breaks below it. So I really don't know how you would necessarily trade this company just because that pattern kind of throws me off. So you have an A to B pattern, but you also have an A to B pattern to the downside. If you go here, reconnect there, down to $2.23, which is a more reasonable, let's say, target than 0. But I can also see where Ford can actually build levels of support, which is basically these areas right here that we have where we made previous bottoms, and they could be price structure areas that Ford could look at. So you do have a bottoming around that $10.10, $10.63, which is your 200 weekly moving average, your $8 region, $5.81, and then $3.92. So those are all areas that I could see a bounce. Now, considering how our A to B to C pattern completes around this $2 to $3 region, I would not be surprised if you have a downturn in the economy, basically kind of stair-stepping down this approach on Ford. However, you can't determine how a stock's going to trade in the long term. It's just giving you key levels. You are pretty bearish, possibly forming a pennant here, which basically bear flag, and then the pennant structure. I'm just drawing a little janky one right now just to illustrate to you guys. So if it's a wedge or a pennant, you basically are completing down here, down into the $7 region. So it's just everything's pointing to very bearish. And also, even with this head and shoulders, if we draw it more conservatively to the bottom of this head, then breaking below this line, you're down into this $2 to $1 region. It's just everything's pointing more bearish side for Ford. However, you haven't broken the 200 weekly, but you are below all the moving average. So just because you have this pennant here, possibly that we can redraw just to be a little more technical about it, basically is the bottom of your 200 weekly moving average. So if you break that, then you're probably going lower. So the key level to watch on Ford is going to be this $10.63 region. If you break that downwards, then you're below the 200 weekly. You have not a lot of price action in this zone between the price point of $10.10 to $7.99. So there could be an interesting buying point once you get down there. However, I wouldn't be surprised if you get a dead cat bounce and then crash down to this $5.81 level, dead cat bounce, and come down to this $3.89. You will have a lot of price action here with volume, just because if you look at the bottom that was carved out here with the volume that occurred right here, I definitely could see this area, even from the $4.47 region to here, as a possible buying opportunity. So we have to keep an eye on that. However, like GM, this company is very bearish on the chart. Now we're going to jump over to Lux Algo just to see what it's telling us. I'm going to plop it on the weekly. So you've been sitting in this price action zone and you're very close to breaking it. Your MACD is crossed bearish on the weekly. RSI is kind of neutral, so it still has room to run to the downside or upside depending on what we form. However, if you start breaking your current price level, targeting probably this $8.67 region, coinciding with that $8.51 we just called out as the first point that we could be bouncing. And then once you go past that, you'll probably head to this reversal zone at into the $6 to $4.72 region on the daily, giving us a little more interaction with price. So let's say we broke that. The $10.31 area would be right where that 200 weekly moving average is sitting. It's actually saying $10.63, so it's the start of the reversal zone. So probably you got to bounce off that 200 weekly, but then you could go lower just because all the signs on the longer term time frames are showing that. Overall, similar to GM, Ford is a very bearish pattern. I would be looking to pick it up once it has a major sell-off, try to form that volume capitulation rally as well. Next, we're going to cover Honda. So taking a look at Honda's graph, you're basically hugging this 200 weekly for all eternity. You have a very, very locked in range for almost a decade at this point, over a decade, where you go up, you go down, you go up, you go down, you go up, you go down, crashing in and out of this 200 weekly moving average. So it's a pretty easy play, I would say. Basically, once you get down to this region of $21.70, you basically buy, and then you run it up to this region of about the $30.89. So this is very, very interesting in so many regards because it's just kind of gone nowhere. This is a trader's dream because they just swing trade the high end to the low end, short it, then go from the bottom, go up, and just wait for their money to grow. And you can see like Honda on the daily chart it's a very gappy stock, so there's not a lot of movement in it because there's lower volume. But if you play this for the long swings with a very low portfolio sizing, I could see where that's appealing. Now you are kind of bouncing and finding support off that 50 daily moving average, but you could be coming back down to retest the 50 weekly or the 200 daily moving average, and then possibly even coming back down to this trend line support down here at $21.50. We're going to dive into Lux Algo to see what it's telling us, to give us a little more hints, because this is a little more difficult graph to understand. So on HMC, which is Honda, we're basically bearish on the weekly because you are crossing on the MACD. However, it could try to diverge back, curl back up, and try tackling this price action zone at 27.17. The support for Honda, in my opinion, would probably come at this $22.89. The level RSI would be on the bearish side at that point, so it'd be an interesting buying point rather than right now where it's a little priced higher than I would like. If you get above this region of about $27.50, possible reversal target of $31.66, and then you would have to see what price structure you create there. On the daily, MACD is significantly bearish, diverged as well, so I do see this selling continue just because of this divergence in the MACD of how spread apart the two lines are, and the RSI has more room to go to the downside, same with oscillation. So first target is that 24.44, second target 23.62, and a runner target I'm going to say is 23.13 as the points that you want to possibly putting an eye on. So with those levels, I would basically trade Honda as a swing trade up and a swing trade down. I wouldn't look to do long-term investing in it just because the graph shows that the company hasn't really moved anywhere, but it's very stable in keeping investors building up their equity into the company is very consistent, and they do pay a dividend. So therefore you can actually just buy and hold the company, and usually because of how it trades, it probably has a pretty decent dividend. So next we're going to jump over to Tesla. We covered this on the channel a while back. I said I was covering it on Investors Day that if we broke down this channel this pennant that we were in, and basically we gapped down, retested it, got rejected off it, came back to the 200 weekly moving average, which we broke down, rejected off of the 50 daily, and now we have a bullish cross of the 50 daily moving average over the 200 weekly. So it's showing the short-term price is being bullish while the long-term price is being bearish. So it definitely shows a bullish cross, as I could call it. Now Tesla could be setting up an A to B pattern here, A to B, B to C, that completes down into this $139 region, which would fill this gap sitting here starting at about the $160 region all the way to 144. And once we got down here, because of the lack of price structure through this massive push, you probably, in my opinion, would be completing a much larger A to B pattern on Tesla. This is from these 313 highs all the way to, I fix this B pointer real quick, all the way down to $5.66. Now, I don't think Tesla gets down to $5.66. However, as we've shown in recent history, anything is possible. So Tesla would have to basically come down, break this point here, and come down lower. I know that I had a much more interesting target on Tesla for A to B patterns. I did say probably this A to B, B to C, completing down in the 144 region that completed. So then we look at the next possible one, which would be here. So that really, because of Tesla's massive push up, actually extended this A to B pattern all the way down to $5.66. We were looking at $88 previously, but I definitely could see that this stock coming down. I wouldn't say all the way to $5.66, but down into the 50s and 80s. I could see that argument. I could also see this argument that this is a invalidated pattern until you get below this $101 price point. If you fill this gap, let's say this is an A to B pattern on the way up, and we come back to fill this gap hypothetically, that projects Tesla back up to 256. So there is a bullish case and a bearish case for Tesla. Now, you are trading above this 200 weekly moving average. And if you get a strong move off of these regions and form an A to B pattern, that let's say this is the bottom, that completes at the 275 point. You have to trade above the 216 point. So it's pretty simple how I would trade this. I would let Tesla do its thing. I would let Tesla get above the $225 point. At that point, I'm above the 50 weekly moving average. We've shown what happens when you're above all the moving averages, and that's an easy 23% return on my money that I don't have to work for. Now, if Tesla starts breaking this moving average down, then I'd be looking towards that gap filling at the least and looking to see what price action Tesla could form. I could see a double bottom at this 101 level. I know a lot of people that invest in Tesla are very, very passionate about the company and where it's going. You did have this massive, massive volume capitulation style rally here. However, the argument that I've presented for Tesla that I don't agree with it being a volume capitulation is because you had higher volume here. So if you look at the comparison at the volumes here and here, it's pretty clear cut that you haven't had a true volume capitulation on Tesla, especially with my theory that the market's going lower this year. I could see the price points of about, I'm going to say the $62 region on Tesla coming back down, or even the $90 region, somewhere off of in these two consolidation areas. I wouldn't be surprised if we retest these prior resistance points here at $62. I could see that happening depending on the price structure that Tesla has, and if we start breaking below this 200 weekly. So for me, it's kind of sit on my hands on this for now, but if we start breaking above this area, then it's easy upside. If we start breaking down here, I'm probably going to take an opportunity to take advantage of this gap fill at 160 and write it down all the way to 144. It's just a simple math, guys, to do. Stocks go up, stocks go down. I see potential in Tesla. I just don't think that it entices an investment at this point just because of what the charts are showing and some of the bearish intonations. Next, we're going to go to Rivian. So if you guys didn't follow our Rivian video, link down in the description below or at the end of this video. I'll have that one linked along with the Credit Suisse video, so if you guys want to check those out. But I did say Rivian is in a descending wedge, and I wouldn't be surprised that we cover and come bounce off this area of $12.46. Ironically, you can see that it's doing exactly what I said it was going to do. It's trying to find a bottom in this region here, try to curl back up, probably retesting $14.88, trying to fill this gap even starting at the $15.95 and the $17.07, probably coinciding with the 50-day moving average and possibly getting rejected there to come back down lower on this wedge. So definitely something to be on the lookout for there. And we look at descending wedges, usually about 80% of the way is where they complete. So I could see Rivian coming up, bouncing here, coming back down in May roughly, and then kind of breaking above this point here. So for me, it's pretty simple with Rivian. I do stand by my analysis that we could see a breakdown if it fails to hold this area. And then if you get rejected at the 50, then you're coming down to this $4.72 region. And guys, there's nothing that says you have to break beyond 80% of the wedge. You could come to the tip of this wedge, which would complete this A to B pattern, and then bounce back up, which would be a massive bounce just because of how depressed the price would be. Completing this A to B pattern, I could see that happening. So I could see Rivian kind of melt down over time, and a lot of people are trying to buy this dip. So I definitely could see a possible move here. I could see possibly a 50% retracement of these levels. So if you consider this the bottom, bouncing up to that $17.20, which coincides perfectly with the 50-day moving average. So I really do see Rivian bouncing here, coming up, retesting the 50, coming back down, possibly coming down to the 78% rate of the A to B leg, bouncing up, possibly get rejected one last time here, come down, complete the A to B pattern, and then afterwards bouncing up higher. I do think the company has a lot of innovation. It has cars that necessarily look very beautiful, which would entice the market. They're getting into electric cars, all this. They got a lot of things going for them, but people don't want to buy growth now. They want to buy stability. Now, if the market sentiment changes, I definitely could see Rivian basically ripping this descending wedge into shreds, coming up, buying at the 20 point. But to me, it's like I could try to scalp the 52% return, or if the A to B pattern completes, I could lose 63%. That's a 1-to-1 risk ratio. I don't want that. I really don't want that, guys. I rather save my money and then take the win once we break this wedge. Basically, let's say we come up to the 47, that's 129% return on my money. It's breaking the wedge. My risk to reward is basically massive because my risk is going to be, well, if you break below the wedge, I get out. That's 3% loss. If I write it all the way up, that's 126. So you're looking at like a 60-to-1 risk to reward. It's a simple trade at that point. Right now, I would advise to stay away just because you're going to let the stock do what it wants to do. Now, if you break above the 50-day moving average on the company, then I could see maybe you riding and accumulating until you get to that wedge, maybe trimming your position, seeing when the retest, so you have some profits there, but then you're not missing the entire move. That's just my opinion on these two companies. And with that, guys, we're going to conclude today's video. Like, comment, and subscribe. We really appreciate any ticker requests that you throw down in the comment section below. We do encourage all new subscribers, if you want to subscribe, throw a ticker down below. We love doing viewer requested ticker Fridays for you, where we conglomerate all the tickers that were requested from the previous week into a video for you, for our viewers. So hit the subscribe button, hit the bell notification so you guys can stay notified for all our videos. And if it's not too much issue, hit the like button. It does really help the YouTube algorithm. And I hope you guys stay tuned for our Fed review meeting that we're going to be coming out tomorrow morning with. So everything you need to know going into the Fed meeting, the reactions possible, the upside targets, downside targets, everything you need to know. So with that, I bid you a wonderful evening and have a good day.